Imagine, if you will, a giant ledger. This ledger tracks all the money coming into a country and all the money going out. This, in essence, is the balance of payments, or BOP. It's a comprehensive record of all economic transactions between residents of one country and the rest of the world over a specific period, usually a year. The BOP is like a nation's financial report card, showing how it interacts with the global economy. It tells us whether a country is earning more from its exports than it spends on imports, whether it's attracting foreign investments, and how much money is flowing in and out through various channels. Understanding the BOP is crucial for policymakers, economists, and businesses alike. It provides valuable insights into a country's economic health, its external vulnerabilities, and its overall position in the global marketplace. For a country like the Philippines, the BOP is crucial due to its reliance on international trade and remittances. A healthy BOP maintains economic stability. A surplus strengthens the financial position, while a deficit can deplete foreign reserves. The BOP helps policymakers make informed decisions on trade, investment, and exchange rates. The BOP is broadly divided into three main components: the current account, the capital account, and the financial account. Each component captures different types of economic transactions, providing a comprehensive picture of a country's external financial position. The current account is the most widely followed component of the BOP. It tracks the flow of goods and services between a country and its trading partners. This includes exports and imports of tangible goods like electronics, machinery, and agricultural products, as well as services such as tourism, transportation, and financial services. The current account also includes primary income, which consists of income earned from overseas investments and remittances sent home by citizens working abroad. Secondary income, on the other hand, covers transfers such as foreign aid, grants, and gifts. While the current account focuses on the flow of goods, services, and income, the capital and financial accounts track the movement of capital. The capital account records transactions like debt forgiveness and the sale of non-financial assets. The financial account is larger and includes FDI, portfolio investment, and other financial transactions. FDI involves foreign companies building factories or acquiring assets. Portfolio investment includes stocks, bonds, and other instruments. The financial account also captures changes in foreign reserves. Section 5. The Philippines BOP, a snapshot. In recent years, the Philippines has generally maintained a surplus in its balance of payments, indicating a healthy external financial position. This surplus has been driven by a combination of factors, including robust remittances from overseas Filipino workers, a growing business process outsourcing sector, and sustained foreign direct investment. However, the Philippines has also experienced periods of volatility in its balance of payments, particularly in the current account. Fluctuations in global commodity prices, changes in global demand for Philippine exports, and shifts in investor sentiment can all impact the country's balance of payments position. For instance, the COVID-19 pandemic in 2020 and 2021 led to a sharp decline in global trade and remittances, putting pressure on the Philippines' current account. However, the country's balance of payments has since recovered, demonstrating its resilience to external shocks. Section 6. Trade in goods, the Philippines' economic backbone. The Philippines has a diverse economy, but trade in goods remains a cornerstone of its economic activity. The country is a significant exporter of electronics, machinery, and agricultural products, particularly coconut oil and fruits. These exports generate crucial foreign exchange earnings, bolstering the Philippines' financial position on the global stage. Maintaining a competitive edge in these key sectors is vital for sustaining a healthy balance of payments. However, the Philippines also relies heavily on imports, particularly of raw materials, fuel, and consumer goods. This reliance on imports can sometimes create a trade deficit, meaning the country spends more on imports than it earns from exports. Managing this trade balance is a delicate act, as it directly impacts the current account and the overall balance of payments position. Section 7. Services, a growing sector. While trade in goods is essential, the services sector is playing an increasingly prominent role in the Philippines' economy and its balance of payments. The country has emerged as a global leader in business process outsourcing, providing services such as customer support, IT, and finance to international clients. This booming sector has become a significant source of foreign exchange earnings, contributing to a surplus in the services account within the current account. Tourism is another vital service export for the Philippines. The country's beautiful beaches, rich culture, and warm hospitality attract millions of visitors each year, injecting valuable foreign currency into the economy. Continued growth in the services sector, particularly in high-value areas like IT and knowledge-based services, will be crucial for diversifying the Philippines' export base and strengthening its balance of payments position. Section 8. Primary income, the role of remittances. One of the most unique and impactful aspects of the Philippines' balance of payments is the significant role played by remittances. Millions of Filipinos work abroad, primarily in the United States, the Middle East, and other parts of Asia. These overseas Filipino workers, or OFWs, send billions of dollars back to their families in the Philippines each year, providing a vital lifeline for many households and bolstering the Philippine economy. These remittances, categorized as primary income in the current account, have a stabilizing effect on the Philippines' balance of payments. They provide a consistent inflow of foreign currency, helping to offset deficits in other areas, such as the trade balance. The Philippines' reliance on remittances underscores the importance of maintaining strong ties with its diaspora and creating an environment that encourages OFWs to continue supporting their families back home. Section 9. Secondary income, international aid and transfers. While remittances dominate the primary income component of the current account, secondary income also plays a role in the Philippines' balance of payments. Secondary income includes foreign aid, grants, and other transfers received from other countries and international organizations. These inflows of funds, while typically smaller than remittances, can be crucial for supporting development projects, providing disaster relief, and addressing specific economic or social challenges. The Philippines, as an archipelago prone to natural disasters, often receives international assistance following typhoons, earthquakes, and volcanic eruptions. These inflows of aid help to stabilize the economy, provide essential goods and services, and support recovery efforts. While secondary income is generally less predictable than other balance of payments components, it underscores the importance of international cooperation and the role of development partners in supporting the Philippines' economic resilience. Section 10. The interplay of balance of payments components. It's important to remember that the components of the balance of payments are interconnected. A surplus in one area can offset a deficit in another, and changes in one component can have ripple effects throughout the entire balance of payments. For example, a surge in exports can lead to an increase in foreign currency earnings, strengthening the current account. This, in turn, can attract more foreign investment, boosting the financial account. Similarly, a decline in remittances can put pressure on the current account, potentially leading to a depreciation of the currency. This depreciation can make exports more competitive, but also increase the cost of imports, impacting the trade balance. Understanding these complex interrelationships is crucial for policymakers in managing the balance of payments and ensuring overall economic stability. Section 11. Conclusion. Balance of payments and economic stability. The balance of payments is a fundamental economic indicator that provides valuable insights into a country's external financial position and its interaction with the global economy. For a country like the Philippines, with its reliance on trade, remittances, and foreign investment, understanding the balance of payments is paramount. A healthy balance of payments, characterized by a sustainable balance between inflows and outflows, is essential for maintaining economic stability, managing foreign exchange reserves, and supporting sustainable economic growth. By closely monitoring the balance of payments and its various components, policymakers can make informed decisions about trade policies, investment regulations, and other economic measures to ensure a thriving and resilient economy. As the Philippines continues to integrate into the global economy, understanding the dynamics of the balance of payments will become increasingly important for navigating the complexities of international trade, finance, and development. The balance of payments, or BOP, records all economic transactions between a country and the world, It shows a country's economic relationships with other nations. The BOP has two main accounts, current and capital. The current account tracks goods, services, and income. A surplus means more earnings from exports than spending on imports. A deficit means more spending on imports than earnings from exports. The capital account records investments and financial assets. A surplus indicates more foreign investment. A deficit, the opposite. BOP helps policymakers understand financial stability and competitiveness. Economic policies can significantly impact a country's BOP. Fiscal policy involving government spending and taxation influences the current account. Expansionary fiscal policy boosts domestic demand, leading to higher imports. Monetary policy impacts the current and capital accounts. Lower interest rates can cause capital outflows and currency depreciation. This makes exports more competitive but imports more expensive. Trade policy with tariffs and quotas directly impacts the current account. The Philippines, a Southeast Asian archipelago nation, has been actively seeking to attract FDI to boost its economic growth. The country has implemented various policy interventions to create an attractive investment climate for foreign investors. One key strategy has been the establishment of special economic zones, or SEZs. These zones offer various incentives to foreign investors, such as tax breaks, simplified business registration processes, and improved infrastructure. The government has also implemented reforms to improve the ease of doing business in the country, such as streamlining bureaucratic procedures and enhancing transparency. Furthermore, the Philippines has been actively promoting its skilled and relatively low-cost labor force as a key advantage for foreign investors, particularly in sectors such as manufacturing and business process outsourcing, or BPO. The government has also invested in education and training programs to further enhance the skills of its workforce. The exchange rate plays a crucial role in shaping a country's BOP. A depreciation of the currency makes exports cheaper and imports more expensive, which can improve the current account balance. Conversely, an appreciation of the currency can make exports less competitive and imports cheaper, potentially leading to a deterioration in the current account. The Philippine government has generally adopted a floating exchange rate regime, allowing the value of the Philippine peso to be determined by market forces. However, the central bank, the Bangko Sentral ng Pilipinas, or BSP, intervenes in the foreign exchange market to manage excessive volatility and maintain orderliness in the market. The BSP uses various tools to influence the exchange rate. For instance, it can buy or sell foreign currency reserves to influence the supply and demand dynamics in the foreign exchange market. It can also adjust interest rates, which can impact capital flows and subsequently affect the exchange rate. Section 5. FDI, a boon or bane for the Philippine economy. Foreign direct investment, or FDI, can be a significant driver of economic growth, bringing in much-needed capital, technology, and expertise. In the Philippines, FDI has played a crucial role in boosting various sectors, including manufacturing, tourism, and BPO. It has created jobs, increased exports, and contributed to overall economic development. However, excessive reliance on FDI can also pose risks. One concern is that foreign companies may repatriate their profits, leading to capital outflows. Another concern is that FDI can sometimes lead to the exploitation of workers or environmental degradation if not properly regulated. The Philippine government recognizes the importance of attracting FDI while mitigating potential risks. It has implemented policies to ensure that FDI benefits the local economy, such as requiring foreign investors to partner with local companies and promoting responsible business practices. Section 6. The Delicate Balancing Act, managing the Philippines' trade flows. The Philippines, like many developing countries, faces the challenge of managing its trade flows to maintain a sustainable balance of payments position. The country has traditionally relied heavily on imports, particularly of raw materials and capital goods, to fuel its economic growth. To address this, the Philippine government has been promoting export diversification, moving away from traditional agricultural exports to higher value-added products and services. The country has seen significant growth in exports of electronics, machinery, and BPO services in recent years. Furthermore, the government has been actively seeking to expand its export markets, particularly in the Association of Southeast Asian Nations, or ASEAN region, and other emerging economies. By diversifying its export markets, the Philippines aims to reduce its vulnerability to economic shocks in any single market. As Section 7, Currency Adjustments, a tool in the Philippine Policy Toolkit. Currency adjustments through depreciation or appreciation can be a powerful tool for policymakers to influence the balance of payments. A depreciation of the currency can make exports more competitive, boosting export revenues and improving the current account balance. However, it can also make imports more expensive, potentially fueling inflation. On the other hand, an appreciation of the currency can make imports cheaper, benefiting consumers and businesses that rely on imported inputs. However, it can also make exports less competitive, potentially hurting export-oriented industries. The Philippine government, through the Bangko Sentral ng Pilipinas, or BSP, carefully manages the exchange rate to balance the benefits and drawbacks of currency adjustments. The BSP considers various factors such as inflation, economic growth, and the external environment when deciding on its exchange rate policy. Section 8. The crucial role of remittances in the Philippine BOP. Remittances, money sent home by Filipinos working abroad, play a vital role in the Philippine economy and its balance of payments. The Philippines is one of the largest recipients of remittances globally, with remittances accounting for a significant portion of its gross domestic product. Remittances provide a stable source of foreign exchange, supporting the country's balance of payments and bolstering its foreign currency reserves. They also provide a lifeline for millions of Filipino families, boosting consumption and supporting education, healthcare, and other essential needs. The Philippine government recognizes the importance of remittances and has implemented policies to facilitate the smooth flow of remittances into the country. This includes promoting financial literacy among overseas Filipino workers and encouraging them to use formal remittance channels. Section 9. From Data to Decisions, How BOP Shapes Philippine Policy. Balance of payments. Data provide crucial insights for policymakers in the Philippines, guiding their decisions on various economic policies. The government closely monitors BOP trends and uses this information to assess the country's external financial stability and competitiveness. For instance, a widening current account deficit may signal that the country is living beyond its means, importing more than it is exporting. This could prompt the government to implement policies to boost exports, such as providing incentives to export-oriented industries or negotiating trade agreements to access new markets. Similarly, a surge in capital inflows, while potentially boosting investment, could also raise concerns about excessive volatility and potential risks to financial stability. This could lead the government to implement measures to manage capital flows, such as imposing capital controls or adjusting interest rates. Section 10. Looking ahead, challenges and opportunities for the Philippine BOP. The Philippine balance of payments faces both challenges and opportunities in the years ahead. The country's reliance on imports, particularly of oil and capital goods, makes it vulnerable to global price fluctuations. A surge in global oil prices, for instance, could widen the current account deficit and put pressure on the Philippine peso. The ongoing trade war between the United States and China also poses risks to the Philippine economy. The Philippines is integrated into global supply chains, and a disruption in trade flows between these two economic giants could impact Philippine exports and investment. However, the Philippines also has opportunities to strengthen its BOP position. The country's young and growing population, coupled with its strategic location in Southeast Asia, makes it an attractive destination for foreign investment. Continued efforts to improve the business environment, invest in infrastructure, and enhance human capital can further attract foreign direct investment and boost exports. Section 11. Conclusion. The ever-evolving landscape of BOP and economic policy. The balance of payments is a dynamic reflection of a country's economic interactions with the rest of the world. Economic policies play a crucial role in shaping the BOP, influencing trade flows, investment patterns, and currency valuations. In the Philippines, the government has implemented various policies to attract foreign direct investment, manage the exchange rate, and promote a sustainable BOP position. Remittances from overseas Filipino workers play a vital role in supporting the economy and bolstering foreign exchange reserves. As the global economic landscape continues to evolve, the Philippines will need to remain vigilant in monitoring its balance of payments and adapting its economic policies to navigate emerging challenges and seize new opportunities. By carefully managing its external financial position, the Philippines can pave the way for sustained and inclusive economic growth.
Welcome to our comprehensive guide on the essence of the international foreign exchange market. Today, we will explore the core functions, participants, key features, and advanced instruments of the Forex market, such as forward contracts, swaps, futures, and options. So let's dive right in and get a detailed understanding of what makes the Forex market tick. The Forex market serves several essential functions that are crucial to the global economy. It facilitates currency conversion, which is vital for international trade and investment. Additionally, it provides a platform for hedging against foreign exchange risk, ensuring that businesses and investors can protect themselves from unfavorable currency movements. Another key function is speculation, where traders aim to profit from fluctuations in currency prices. Each of these functions plays a significant role in maintaining the stability and efficiency of the global financial system. The Forex market is a complex ecosystem with a diverse range of participants. Major players include central banks, which influence currency prices through monetary policy and interventions. Commercial banks and financial institutions provide liquidity and facilitate transactions. Multinational corporations engage in Forex trading to manage their foreign exchange exposure. Hedge funds and investment managers participate to achieve better returns for their clients. Lastly, individual traders and retail investors also contribute to the market's dynamics. Each participant has a unique role and impact on the Forex market's overall functioning. The Forex market boasts several key features that distinguish it from other financial markets. It operates 24 hours a day, 5 days a week, allowing for continuous trading across different time zones. For instance, when the trading day ends in New York, it begins in Tokyo and Hong Kong. The market is highly liquid, with a daily trading volume exceeding $6 trillion, making it the most liquid market in the world. This high liquidity ensures that traders can buy and sell currency pairs with ease, minimizing the risk of price manipulation. Furthermore, the Forex market is decentralized, meaning there is no central exchange. Trading occurs over the counter through a global network of banks, brokers, and financial institutions. This decentralization allows for greater flexibility and accessibility, as traders can operate from anywhere in the world. These features contribute to the market's efficiency and accessibility for traders worldwide. For example, a trader in London can easily execute a trade with a counterpart in Sydney, thanks to the interconnected global network. Additionally, technological advancements have further enhanced the Forex market's accessibility. Mobile trading apps and sophisticated trading platforms enable traders to monitor and execute trades on the go, ensuring they never miss an opportunity. In summary, the Forex market's round-the-clock operation, high liquidity, decentralization, and technological integration make it a unique and dynamic environment for traders around the globe. Forward contracts are customized agreements between two parties to buy or sell an asset at a specified price on a future date. They are not traded on exchanges and are considered over-the-counter instruments. These contracts are used to hedge or speculate on the future price of an asset. Because they are customizable, forward contracts can be tailored to fit the specific needs of the parties involved. Swaps are derivative contracts where two parties exchange financial instruments. The most common type of swap is an interest rate swap, where one party exchanges a stream of interest payments for another party's stream of cash flows. Swaps can also involve currencies, commodities, or other financial assets. They are used for hedging risk or for speculative purposes. Futures are standardized contracts to buy or sell an asset at a predetermined price at a specified time in the future. Unlike forward contracts, futures are traded on exchanges and are subject to daily settlement procedures. These contracts are used by hedgers to manage price risk and by speculators to profit from price movements. Futures contracts are highly liquid and have standardized terms. Options give the buyer the right, but not the obligation, to buy or sell an asset at a specified price before a certain date. There are two main types of options: call options and put options. Call options give the buyer the right to purchase an asset, while put options give the buyer the right to sell an asset. Options are versatile financial instruments used for hedging, income generation, and speculative purposes.
I bet you didn't know there's a global market where currency flies free from its home turf. This market is vast and intricate, involving numerous players and transactions that span across continents and time zones. Yep, it's called the euro currency market. But don't let the name fool you. It's not just about euros or Europe. This market encompasses a wide range of currencies from all over the world, each playing a crucial role in the global financial ecosystem. Euro currency isn't just about euros. In fact, it includes any currency deposited outside its home market. This means that currencies like the US dollar, Japanese yen, and British pound can all be part of the euro currency market when they are held in banks outside their respective countries. It's any currency deposited outside its home market. This unique characteristic allows for a more flexible and dynamic financial environment, where currencies can be traded and utilized in ways that might not be possible within their home countries. For example, US dollars in a UK bank or Japanese yen in a South African bank. These deposits are part of the euro currency market, providing opportunities for international trade and investment that transcend national borders. This market started in Europe, but today it's global. The euro currency market has expanded far beyond its European origins, becoming a vital component of the global financial system. It facilitates international trade, investment, and economic growth by providing a platform for the free flow of capital across borders. It's a playground for banks, multinational corporations, and hedge funds looking to dodge domestic regulations and tax laws. These entities leverage the euro currency market to optimize their financial strategies, seeking out the best opportunities for growth and profit. Euro currency markets offer lower interest rates for borrowers and higher rates for lenders, thanks to lighter regulation. This makes them an attractive option for both borrowers looking to reduce their costs and lenders seeking higher returns on their investments. But be warned, they're riskier, especially in a financial crunch. The lack of regulation that makes the euro currency market appealing also introduces significant risks, particularly during periods of financial instability. Investors and institutions must navigate these risks carefully to avoid potential losses. Take Eurodollars, the OG of euro currency. Eurodollars are US dollars deposited in banks outside the United States, and they have been a cornerstone of the euro currency market since its inception. They're US dollars traded outside the US with an average daily turnover of $140 billion. This massive volume of trade highlights the importance of Eurodollars in the global financial system, providing liquidity and facilitating international transactions. And it's not just dollars. There's Euro yen, Eurobonds, and more. These instruments represent a wide array of currencies and financial products that are traded in the euro currency market, each offering unique opportunities and challenges for investors. So, next time you hear euro currency, think global finance, not just Europe. The euro currency market is a testament to the interconnectedness of the modern financial world, where money moves seamlessly across borders, driving economic activity and growth. It's a whole world of money, moving beyond borders. This movement of capital is essential for the functioning of the global economy, enabling businesses to expand, governments to finance projects, and individuals to invest in opportunities around the world. Euro currency refers to any currency deposited outside its country of origin. This includes Eurodollars, Euro yen, and more. These deposits are a key part of the global financial system, providing liquidity and facilitating international trade and investment. The advantages of Euro currency markets include lower borrowing costs and higher returns for lenders due to less regulation. This makes them an attractive option for both borrowers and lenders, driving demand for Euro currency deposits and transactions. However, the disadvantages are significant risks, especially during financial instability. The lack of regulation that makes the Euro currency market appealing also introduces significant risks, particularly during periods of financial instability. Investors and institutions must navigate these risks carefully to avoid potential losses. For instance, Philippine pesos deposited in a bank outside the Philippines would be considered Euro currency. This allows Philippine businesses to access international capital markets, providing opportunities for growth and expansion. This can benefit Philippine businesses by providing access to international capital at competitive rates. By tapping into the Euro currency market, businesses can secure financing that might not be available domestically, enabling them to invest in new projects and expand their operations. So whether it's dollars, yen, or pesos, Euro currency is a key player in global finance. The Euro currency market is a vital component of the global financial system, facilitating the flow of capital across borders and driving economic growth and development. The Euro currency market has a rich history, dating back to the 1950s when it first emerged as a way for European banks to hold US dollars outside the United States. Over the decades, it has evolved and expanded, becoming a crucial part of the global financial landscape. Initially, the market was driven by geopolitical factors, such as the Cold War, which led to an increase in US dollar deposits in European banks. These deposits were used to finance international trade and investment, laying the foundation for the modern Euro currency market. Today, the Euro currency market is a sophisticated and dynamic system, involving a wide range of financial instruments and participants. It plays a critical role in the global economy, providing liquidity and facilitating international trade and investment. The market's growth has been driven by several factors, including advances in technology, deregulation, and globalization. These factors have made it easier for currencies to move across borders, increasing the volume and complexity of Euro currency transactions. Technology has played a particularly important role, enabling real-time transactions and the efficient management of large volumes of data. This has made the Euro currency market more accessible and attractive to a wider range of participants. Deregulation has also been a key driver, reducing barriers to entry and allowing for greater flexibility in how currencies are traded and used. This has led to increased competition and innovation within the market. Globalization has further expanded the reach of the Euro currency market, connecting economies and financial systems around the world. This interconnectedness has created new opportunities for trade and investment, but it has also introduced new risks and challenges. One of the key benefits of the Euro currency market is its ability to provide liquidity to the global financial system. By allowing currencies to be held and traded outside their home countries, the market ensures that there is always a supply of capital available for international transactions. This liquidity is essential for the functioning of the global economy, enabling businesses to finance their operations, governments to fund their projects, and individuals to invest in opportunities around the world. The Euro currency market also provides a platform for managing currency risk. By holding and trading currencies outside their home countries, participants can hedge against fluctuations in exchange rates, reducing their exposure to currency risk. This is particularly important for multinational corporations and financial institutions, which often have significant exposure to multiple currencies. By using the Euro currency market, they can manage their currency risk more effectively, protecting their profits and ensuring financial stability. However, the Euro currency market is not without its challenges. The lack of regulation that makes it attractive also introduces significant risks, particularly during periods of financial instability. During a financial crisis, the value of currencies can fluctuate wildly, leading to significant losses for participants in the Euro currency market. This volatility can be exacerbated by the lack of oversight and regulation, making it difficult to manage risk effectively. Despite these challenges, the Euro currency market remains a vital component of the global financial system. Its ability to provide liquidity, facilitate international trade and investment, and manage currency risk makes it an essential tool for businesses, governments, and individuals around the world. As the global economy continues to evolve, the euro currency market will likely play an increasingly important role. Advances in technology, changes in regulation, and the ongoing process of globalization will shape the future of the market, creating new opportunities and challenges for participants. In conclusion, the euro currency market is a complex and dynamic system that plays a crucial role in the global financial landscape. By providing a platform for the free flow of capital across borders, it facilitates international trade and investment, drives economic growth, and helps manage currency risk. Whether you're a business looking to expand internationally, a government seeking to finance a project, or an individual looking to invest in global markets, the euro currency market offers a range of opportunities and benefits. However, it's important to be aware of the risks and challenges associated with the market. The lack of regulation and the potential for volatility mean that participants must navigate the market carefully, using effective risk management strategies to protect their investments. By understanding the intricacies of the euro currency market and staying informed about the latest developments, participants can make the most of the opportunities it offers while minimizing their exposure to risk. So, next time you hear euro currency, think beyond Europe. Think about the global financial system, the interconnectedness of economies, and the opportunities and challenges that come with the free flow of capital across borders. The euro currency market is a testament to the power of globalization and the importance of international cooperation in finance. It shows how currencies can move beyond their home countries, driving economic activity and growth on a global scale. Whether it's dollars, yen, pesos, or any other currency, the euro currency market is a key player in the global financial system. Its ability to provide liquidity, facilitate trade and investment, and manage currency risk makes it an essential tool for participants around the world. As we look to the future, the euro currency market will continue to evolve, adapting to changes in technology, regulation, and the global economy. By staying informed and understanding the market's dynamics, participants can navigate its complexities and make the most of the opportunities it offers. In the end, the euro currency market is more than just a financial system. It's a reflection of the interconnectedness of our world. It shows how money can move beyond borders, driving economic growth and development on a global scale. So the next time you think about euro currency, remember that it's not just about Europe. It's about the entire world and the ways in which currencies can move and be used to drive economic activity and growth. The euro currency market is a vital component of the global financial system, and its importance will only continue to grow in the years to come. By understanding its intricacies and staying informed about the latest developments, participants can make the most of the opportunities it offers while managing the risks effectively. In conclusion, the euro currency market is a complex and dynamic system that plays a crucial role in the global financial landscape. By providing a platform for the free flow of capital across borders, it facilitates international trade and investment, drives economic growth, and helps manage currency risk. Whether you're a business looking to expand internationally, a government seeking to finance a project, or an individual looking to invest in global markets, the euro currency market offers a range of opportunities and benefits. However, it's important to be aware of the risks and challenges associated with the market. The lack of regulation and the potential for volatility mean that participants must navigate the market carefully, using effective risk management strategies to protect their investments. By understanding the intricacies of the euro currency market and staying informed about the latest developments, participants can make the most of the opportunities it offers while minimizing their exposure to risk. So, next time you hear euro currency, think beyond Europe. Think about the global financial system, the interconnectedness of economies, and the opportunities and challenges that come with the free flow of capital across borders. The euro currency market is a testament to the power of globalization and the importance of international cooperation in finance. It shows how currencies can move beyond their home countries, driving economic activity and growth on a global scale. Whether it's dollars, yen, pesos, or any other currency, the euro currency market is a key player in the global financial system. Its ability to provide liquidity, facilitate trade and investment, and manage currency risk makes it an essential tool for participants around the world. As we look to the future, the euro currency market will continue to evolve, adapting to changes in technology, regulation, and the global economy. By staying informed and understanding the market's dynamics, participants can navigate its complexities and make the most of the opportunities it offers. In the end, the euro currency market is more than just a financial system. It's a reflection of the interconnectedness of our world. It shows how money can move beyond borders, driving economic growth and development on a global scale. So, the next time you think about euro currency, remember that it's not just about Europe,